I welcome you all to the second session for today. We have with us CA Suhas Pai. He will be guiding us on two important auditing standards. Auditing standard on related parties and on going concern. It's very difficult to understand relations, even more so in the field of accounting and auditing. So to guide us on these two, we have with us CA Suhas Pai. For the introduction of this faculty, I would like to invite CA Krishna Kumarji, who is a past candidate.
Morning, friends. After this ये कृष्णा जी का फोटो नहीं आ रहा,
बंद करो, पीडीएफ बंद कर दो। कोई बात नहीं, रख दिया।
So good morning, friends. Morning. After this heavy breakfast, how you are feeling? So today we had called CA Suhas Pai, who is expert in auditing. So I was just talking to him. So he was telling that audit is my blood. So he will prove that how auditing is in his blood. So just to introduce, CA Suhas Pai is an associate member of Chartered Accountants of India. So you must be wondering that he does not look like associate member, but he is having 2 decades of experience. So he had passed his bachelor degree of commerce from Mumbai University in 2000 and qualified Chartered Accountancy course in 2003. Suhas also holds a degree of DIP IFR diploma in International Finance Reporting by ACCA UK. About his professional career, Suhas has joined BSR and Company LLP in August 2008 and currently an associate partner with the firm. He works for all the audit and assurance practice. His professional career spanned 2 decades. He had completed his articleship training with Deloitte in audit and conducted his post qualification until 2006 and later he joined KPMG UAE until 2008. He has been associated with BSR and Company LLP since 2008. So he had worked almost all out of 3 big 4 he had worked. His professional career, Suhas has worked across wide spectrum of large and medium and small companies in India and multinational business. He had worked with companies in real estate, industrial, concern, market, consumer products, telecom, information technology, tourism and telecom sector. Being an audit professional, Suhas has developed profound understanding of business environment, business risk control, accounting, and financial reporting issues relevant to business operating in India. Suhas is IFRS accredited partner with the firm and he has been a reviewer for evaluation of annual reports for ICI awards for excellence in financial reporting. He is also an active speaker internally within the firm and also at the various study circles. With this, I request today's speaker, before he starts, I request our past convener Mahesh Bagaria ji to give him the memento.
कोई बात सब पहले कौन सा स्लाइड चेंज नहीं है दूसरा खोलेंगे ना पहले ओपन करके फिर शेयर करेंगे वरना वो जूम करके अली कमेंट
Hello, am I audible? Yeah.
इस पे क्यों नहीं आ रहा है सर आप स्टार्ट कीजिए मैं दोनों सेट कर देती हूँ इस पे नहीं आ रहा है मुझे अभी आया
Good morning, friends. Thank you. It's a coincidence that morning session was on two-letter words called foreign assets. Now I'm going to take two-letter words for related parties, and after that, again a two-letter words called on going concern. It's really a coincidence. In terms of related parties, so related parties these days, or rather when I was doing my articles back almost 2 decades back, no one thought about reading related parties in depth. These days, and it was very small standards. And today also, there is always a misconception to say that related parties is only for the notes to accounts. But once you see a couple of first or two slides, there will be an eye opener that related parties is not only a notes to accounts related matter, but that has to be a very detailed deep diving into it. And it has its own repercussion in terms of non-compliance with the auditing standards of SA 550. So why audit of related party and related party transition is critical? So this, I'll just flip on, let me go to the last thing. So these are the snippets from the NAFRA reports. Like if you see on this side are all the on audit firms. These are from the NAFRA. All the recent communications and observation which they have from a recent file. They have been talked about audit firm has failed to notice. Audit firm failed to evaluate management assertion. Audit failed to communicate. Audit failed to obtain sufficient audit evidence. And these two are, sorry, apology for the overlapping in terms of this format. The first two are the news snippet for two of the almost 3 years back. One would be on the Bhushan Steel. The other one is this particular is on the CG Power. So if you read this, it becomes probably a fresh chart accountant or other who's pursuing a chart accountant. When they read this, becomes a matter of worry for them. So in terms of related parties, it's not only a notes to account, it is very, very critical in terms of how do we audit those.
So over the agenda, to keep it very simple, would be identification of related parties is very critical. Once you identify, how do you collate the information? There will be step two. Once you collate, how do you disclose and get into a noster account will be the step three. And so here, in lastly, also the fourth point is the nowadays even NAFRA has come out to say that whatever observation and auditors have, how do you communicate to those as governance? Those are governance who are the board members and all those things. And also there are other various thingy like CARO reporting, which is an auditor's long form audit opinion, which has various aspect of related party flowing into it. I have one slide on, I'll just explain that. And then there are of late many qualifications, and some of them are also going to disclaimer of an opinion or an adverse opinion for any for the matters related to related party. So related party is very critical in terms of the own standard. It is very simple to read. It can be less than 5 pager, but it has its own repercussion in case of not complied in full spirit. I'll just go on. So in terms of regulatory framework in India, along with SA 550, which I'm taking it to, you also have CARO reporting, it's called auditor's long form report. Then there are accounting framework, Ind AS 24 for companies following Ind AS, accounting standard 18 who are following accounting standard. Provision of Companies Act, there are lots of provision of Companies Act which covers the related party. Provision of income tax as well, and SEBI LODR for listed entities. Of late, listed entities, there have been lot of changes which is there in terminology of related parties. While someone would say right from the one to the income tax, they would be overlapping and almost all related parties would get covered. But in terms of LODR, there has been lot of changes where the identification of related parties could be more stringent and the scope would have been increased, and so the disclosure as well. This is an object, or the main objective of SA 550 is to recognize any fraud risk factors in terms of an auditor, identifying any related party transaction. And the critical part is to obtain audit evidences about whether related party transactions have been appropriately identified, accounted, and disclosed. So one is identification, one is accounting for it, third is disclosure. This is where the NAFRA these days have been harping upon that the management and so-called the auditors are missing out to it. Before I go, how many of in this group, in this room would be an auditor or from an audit firm, so that I can, okay. So I'll be mind, and how many from the management probably not having into any audit firm, they would be like a CFOs or a finance team. Thank you. So the overall, this is the snippet about the overall 9 bullet point which I'm going to cover in related parties. The theme remains the same: identification, collation, and then disclosure, and then communicating to Joseph governance. So, and what I've done is I have also kept some case study as well, so that will be easy to comprehend this matter. And along with that, if there are anything in terms of NAFRA point, what NAFRA is talking about these days, and also definitely these are all from the auditing standard. So the first point is, for first question would be rather, an engagement team rebutted the risk of fraud. So there is an auditing standard on SE 240 which says any risk and in terms of how do you document it. So here they mentioned is that, sorry, the engagement team has rebutted risk of fraud in revenue since all transactions are related party. Therefore, no significant risk has been identified in revenue. So here the question is this an appropriate right step on the auditors? When NAFRA reviewed this, NAFRA felt that auditors should have evaluated and understand the nature, and accordingly existence is one of the factors which determine the significant risk. So moment you have, as per the other auditing standards, moment you have a significant risk, automatically you will have other downfall in terms of testing those controls, and your sampling in terms of a test of details. All those things will flow through. So one of the observation where NAFRA pointed out that the auditors have missed out, specifically though it is with the related party transaction, the audit team might have felt that, or the management would have felt that, since their entire transaction has been confirmed by the other party, so the work has been done. It was not the way. The way the auditing standard evaluates is saying that you need to identify and test the overall controls as well in terms of the related party transaction. So here, if you see the fact pattern, company A announced expansion in very key Asian market, but struggled to meet analyst expectation during the year, which caused decline in the stock market. Directors of company B, okay, that is the holdco, have significant influence over company C, mainly a retailer of company A. Company A recorded substantial higher sales in C because becoming a largest customer, representing 50%. So here there were two things. One is there's a lot of pressure on company A to for an expansion and to increase their stock price or increase their overall turnover and all those things. So engagement team should evaluate the risk fraud and identify risk in the revenues thing. So friends, here whenever you do any sort of identification of significant risk, and more so if it is the related party, one thing which you need to bear in mind that you will have to identify significant risk, and you need to be very professional skepticism in identifying those. The second part would be now, how do you identify a related party and what type of work would you do around related parties? So related parties are covered by various, as I earlier mentioned about section 276 of this Companies Act, Ind AS 24, AS 8 is, yeah.
Let's say in a private equity company, they have identified, they have reported the proper related party transaction. But as an auditor, I feel that most of the profits have been taken out as a salary on a professional basis by a related party. So how to judge or how to professionally say whether the transaction is at first arm's length price, and if it's not, and if you feel that it is not at arm's length price, so what is the comparable that we can use and how to report it in the audit?
Correct. So it's a good point. In terms of identification, once you identify the party for arm's length, as I told, there should be a controlled perspective. You should ask the management first. How did they ensure it's an arm's length? For an example, you're going to take you took a property in say a next door or something. So there and the holding company has given to subsidiary company the particular piece of a property or a rental thing. There you have to benchmark the rate. What if it is not, if the transaction is done with unrelated party? If the unrelated party, say for example, is 150 rupees per square feet, and with the related party it is given at say 140 or 130 or 160, whichever way that is. So then you have to identify. So basically, one that management has to identify this in their control metrics as per IFC also, where they'll identify the controls and they will test it first, and then auditors would identify it. Assuming after the testing also as an auditor we are not satisfied, there is a specific modification of auditor's opinion, right, from SA 700 to 705, which allows you to bring those matters out into auditor's qualification. There are certain examples which I told you in a real fact case where many auditors have qualified the account in absence of any arm's length in terms of transaction with the related party transactions. So here in terms of regulation, be it on Companies Act, Ind AS and accounting standard, overlapping, they're almost is same. But in terms of SEBI has kept on modifying the requirement in terms of identifying related party transaction one and also reporting to it. So here for an example, from 1st April 2023, they have said that any person or any firm which holds more than 10% should now be part of the related party disclosure as per SEBI. And earlier, promoter or a promoter, even if doesn't hold the shares, they were never being part of, because here, if you see in Companies Act or in accounting standard, everyone should hold the shares. But assuming a promoter is being tagged to a company but it doesn't hold a share, as per SEBI requirement, those will still be called a related party. So assuming a listed company follows this would be a bit more stringent. For an unlisted company, at least with section 276, Ind AS 24 and AS 18 would be easy to handle with this. This is one of the concept called connected parties. This has specifically happened, if I remember correctly, in CG, where though it was not a related party, but it was a round robin. Earlier we used to have a earlier concept of diamond structure, where a company doesn't hold shares in any other company, but however, being a connected parties would have done a transaction. For example, company A, company B are related parties, B is subsidiary, and company A sells good to company B, and company B sells independently to company C, and company C is no relationship with company A or B. So here you have to be very mindful in terms of company C. The question from an auditors in terms of professional skepticism would be, why didn't company A sell directly to C? Why did it through B? So all those things, there would be business rationale. There should be also be reviewed the commercial substance as well in terms of what needs to be reviewed as well. Sometimes there will be an example granting of loans, like when A give a loan to a B who is unrelated party, it doesn't fall in any definition of what we learned one slide before. If there are no transactions with those, but still there are no relationship with those party, but still loan has been given. Loan has been given, and in spite of being mindful that company B or company C in this example doesn't have a sufficient funds to pay back. So these are all connected parties, and one of the recent, as I told you, on CG company, there was this particular matter was reported, and finally it went to a disclaimer of an opinion for those things where there were transactions with connected, so-called connected parties. There are no definition of connected parties, but it is more about being very professional skepticism. While there are certain examples which I've listed out here. For example, sales transaction with large discounts or returns. Then there are there are a lot of barter exchange for a transaction. Goods are sent less than the cost. Loans are with no schedule for repayment. If it is related party with wholly owned subsidiary, probably you may say that it's a end of day the holdco has to give benefit to the subsidiary. But with any other parties, you will just be mindful about this particular transaction. This generally happens in very large companies, and where there are promoter group where company A and B will be related, but there will be no relation with company C. So that should be very mindful in terms of these transactions. So this is who is related parties and with whom should generally the conversation, or in terms of how do you identify? So these are the various stakeholders in a general company. If you think about management, those are the governance would be a director, board of directors. Your internal audit, who are dealing with the various aspects of the internal audit. In-house legal counsels and the compliance officer. Compliance officer may be company secretary as well. So what type of inquiry would generally one do? So there will be management would be governance structure, organization structure or something. Those are the governance we'll have to inquire, because those they get probably a related party transaction with maybe omnibus approval, non-omnibus approval. So those type of thing would be there in those are governance. Internal audit are those who are dealing with the transactional audit. So they will be very close to ground reality to say that is there any business rationale and justification. In-house legal, how is it structured and how it is financed. And compliance officer is to understanding the related party processes and control in place. So this is as per auditing standard 550 with para 14, and there's a guidance on AS15 as well. So these are the list of parties where generally one would inquire, and these are the things what would generally one would want to talk about. Generally what we have seen is, in my experience, is that generally we may talk about with the management and forget to deal with the other stakeholders. So this is very critical in terms of, once you do this, at least you will be rest assured that you have spoken to various stakeholders and this have been covered. Definition of related party I just spoke about. So as I mentioned earlier, these two buckets are the one which are very critical, which has come in from 1st April 2022 and 1st April 2023 in terms of any person holding more than 10% shareholding. So here, so there are some 6 case studies which I have prepared out here. So the question one is the wife of a director who is not a KMP of a company, a related party of the company? So for example, company A, where we are auditing, the question is that whether it be related party, the wife of a director who is not a KMP. So we are bucketed into various things: Companies Act, Ind AS thing, and SEBI. So from Ind AS 24 and Ind AS 18, it says depend upon whether it's a control or significant influence is a KMP. So Ind AS and AS generally focus is more about control aspects. So here in Companies Act, it gets covered into relative definition, and in SEBI is definitely it's covered. So next question is Company X provides key managerial services to Company Y. Key manager services means like I have a firm, say Suhas and Co. And there's a company A. I have like a managed services like a CFO or a CEO or company secretary on a rotational basis. This generally happens into MNC type of companies. So the question is company X, like in my case, company X provides a key manager to company Y. Is company Y a related party to company X? So very interesting out here. Companies Act says no. SEBI definitely will be yes. From an Ind AS 24, this is covered in the definition of Ind AS 24 as per accounting standard Ind AS 24, but unfortunately not covered under IGAP, the erstwhile AS 18. Those are not covered. This is very specifically yes covered by definition of from the Ind AS. So if those are the cases, so in company Y, they will definitely have called company X because it believes that since they have appointed someone else, the control are there with the company who is appointing them, the firm who is appointing them. Each stepbrother of a KMP or related party of a company, the company is a standalone entity and stepbrother does not have any voting power. So the purpose of showing this case study is very critical is step one is to identify related parties. If we fail to identify proper related party, the step two in terms of collation of the transactions and performing controls or test of details, and lastly disclosure will definitely skip this through. So in terms of Companies Act, it specifically covers in the relative. In Ind AS 24, yes, if it qualifies as close member, and in AS 18 it is no. In SEBI, the answer is yes. So fourth case study is company A and C are private companies and have a common director. Are they related party based upon this limited fact pattern? So there are two company A and B. And for example, Suhas is the common director for company A as well as company C. So would this be called a related party under various statute? So under Companies Act is yes, because the definition covers under 276. Ind AS and AS saying no, merely because common director doesn't mean two companies are related. In SEBI, the answer is yes. Now here the fifth case is X is a promoter of a company XYZ and holds 18% of share capital in company. Will X be the related party of company XYZ? The answer technically someone would say yes, but since it is holding below 18%, there is no significant influence. The Companies Act would be no. Accounting standard also no, because there is no significant influence. And SEBI, the answer is yes, because it is more than 10%. Company H has significant influence on both company S and company T. Are company S and T related parties? The answer is no. It's just that because S and T have nothing to do in terms of company X having significant influences.
What will be the case in case number 5, sir? When promoter is having more equity share?
No shares.
No share.
No share. So
where it will be related, where it will be not.
So if the company, if it has no shares, it will straight away come in SEBI.
SEBI yes, otherwise.
No.
Same as this.
Same as this. But if he's on a board and having a control position, then probably Ind AS would get captured. This is an approval mechanism in terms of Companies Act. So here also very critical in one of the qualification and one of the NAFRA subject matter was that there was also an observation found on that management has not performed the necessary approval mechanism. So on the left hand side, this is more from a Companies Act perspective. On the right hand side, it is more from an LODR perspective. Both are slightly different. If you see in Companies Act, all transactions has to get approved by audit committee. This one. audit committee. And if it is ordinary course of business, okay. If yes, no further. Like if it is in section 188 of Companies Act, if it is an ordinary course of business and at arm's length, no further action required. If it is no, board, it will go to the board for approval. And then if there are certain cases to be approved, yes. Otherwise, you need an ordinary resolution in case of a from a shareholder of this company. When you go to LOTR, LOTR has a very unique situation to call material transaction. Now, this material transaction means 10% up to April, from 1st April 2023, it is 10% of the consolidated turnover or 1,000 crore, whichever is less. So this is also very critical, and this requires a prior approval of the shareholders. This is very, very critical. This requires a prior approval of shareholders. For an example, a particular transaction, we are in month of September. As we go in October, there's a transaction which happens, which say exceeds 10% of the consolidated turnover. For an example, consolidated turnover was 5,000 crores. There's a corporate guarantee or some sort of a transaction happen with the subsidiary. So here and it's not a whole, if it's a wholly owned subsidiary, there is exemption given in SEBI. But if there is, say, a joint venture or an associate or less than 100% shareholding, not a wholly owned subsidiary, so those would require, for an example, the turnover is 5,000 crores. The transaction in our example should not exceed 500 crores or 1,000 crores, whichever is less. And a transaction happened to be, say, 550 crores. So here is very, very critical that you need to have prior approval of the transaction. And if it is not a material transaction, no further approval is required. So there are two sets of a different thing. Whilst the example of my in final group, probably in the Companies Act, it may get passed through because they may feel it's an arm's length. Here, irrespective of arm's length or not, on the board, you need to have a prior approval of shareholders. Just be mindful. The only exemption is when a transaction happens with a wholly owned subsidiaries. It's completely exempted in this case. This is again on identification of a related party with para 13 and 14, and this is one of the NAFRA observation is that is engagement team required to perform inquiries even if listing is obtained by management. So it was very, very critical in terms of the observation with NAFRA when they were dealing it and with the auditors. Auditors felt that they had already got this list from these companies and with the various stakeholders. Why would one need to still go and inquire? So here in terms of the requirement is that here in terms of requirement that identify the individual other than management, like we earlier discussed, be it internal audit, be it chief finance officer, be it company secretary, those also we need to inquire with board members as well. In this particular case file of NAFRA's observation, it was only done with probably with the financial controller or with the CFO, and they missed to have a conversation with other team member. So having a conversation face to face or through an MS team is very critical, and not just having into a proper rather to only through inquiry. You need to have proper inquiry and document it, and also have with various stakeholders as well. And this is also covered under various other auditing standards, be it SC 240, which require auditor to conduct inquiries with management, TCW with those charged with governance, and others. So all others would be internal audit, compliance team, legal team, those all will get scoped in to discuss. And definitely, and the very critical part is generally as an auditors, we may tend to take a representation letter. Friends, be mindful, representation letter is not a substitute for inquiries of management. You will have to inquire and also document on the file that inquiry was done by documenting either the minutes of invite or documenting the email exchange with those parties with whom we have a conversation as well. This, like in terms of KMP, what are the key consideration to drive to say that he or she is a KMP? One would be one critical test is that if he has authority and responsibility for planning and directing and controlling. And so here it is not limited to a person, it's limited to a role. Like for an example, CEO would definitely will fall into authority and accountability. And here, one thing which is covered under Ind AS 24 specifically is generally executive directors get into this role of authority and responsibility. Ind AS 24 specifically has scoped in non-executive directors as well to be part of related parties. And here, so now take an example. Is every company required to disclose company secretary and CFO as KMP of the company financial statement? The fact pattern says that if you ask me fact pattern is the CEO is the only authority and responsibility. Probably in this fact pattern, company secretary and CFO are not involved in day-to-day in terms of authority and responsibility. So even if there's a decision to take in terms of budgeting, it goes through the process of CEO. CEO takes the final call. So in this case, would these two role we call it the KMP of in final statement? From the perspective of Companies Act Section 203 call them a KMP, but from an Ind AS 24 perspective, disclose if they have authority and responsibility. So it is very case to case specific where each of the organization would have to need to follow this. And merely because CFO and as per Companies Act, they will not be KMP in financial statement for accounting framework. This is also critical, not necessary that they will be, since they are KMP as Companies Act Section 203, but in terms of KMP, because they are not involved in authority and responsibility framework, they will not be called. So here also, whatever judgment and whatever conversation which we have, we'll have to document into our audit file to say that since these people are not involved in authority and responsibility, they are got scoped out, and that is why they are not being called it under KMP. So this is a case study where company Z and company X is an investment company holds 100% in company Z. Y is a director at company X, and Y is also heads the treasury and responsible for key planning, directing, controlling decision at company Z. So Y is also involved in this discussion out here. A is executive director, B is a non-executive director, C is a financial controller, and S is a member of supervisory board. Supervisory board means to set overall strategy and is responsible for and involved in implementation of the strategy. So the question is now, let's see in terms of various stakeholders whether they will be called as KMP. So so we have A, B, C, X, and Y. So A definitely because he's an executive director and having the authority responsibility for this. So A will be there. In terms of B, since he is a non-executive director, as per Ind AS would require to be called as a related party. C would depend about if she has a authority or responsibility. We just discussed a slide back. And S, since S is also involved in and she is part of the supervisory board, she will get Mr. S will get also scoped in. And Mrs. Y, since her role says that she is responsible for key planning and direction, she also will get involved as part of a KMP. This is from the company Z perspective. So this is very critical for us to identify and document appropriately in an audit file when during a planning stage. So here company A, who owns 100% in X and is a KMP in company Y, and company Y owns 100% in company Z. The question is, who are the related parties for entities X? Entities X, Y, and Z in respective financial statements. So here we will quickly go through three of them. So in company Y, since A, so we are now evaluating company Y, so company X first. So in company X, since A is a KMP in company Y and also controls the reporting entity, so those will get involved. Company Z, because since KMP is involved here, so even this will get scoped in. So from a perspective of company X, KMP company X, Y, and A will be part of Y and Z and A will be part of related party transactions. Similarly, for company Y and company Z, those will be, so here in company Y, which is here, company X would be a KMP because here A has a control over company X, so this two will be get related. And since company Z is subsidiary, this will get a part of related party transactions. In terms of, this is also a NAFRA observation where the company had 8 executive directors, and of which only 4 were being called as a key managerial person and disclosed in the related party transactions. The engagement team agreed with the engagement with the management identification and disclosed this as a KMP. The question is, did engagement team perform adequate audit procedure to ensure the completeness as per related party listing? So the expectation would be that not all directors will fall under KMP as we discussed earlier, but there were no proper identification or documentation in audit file to say that you need to obtain entire list of related party as per probably 3CD, transfer pricing report, and various other, and also have inquiry with other stakeholders. And this evaluation should have been done appropriately. So here is very critical from the perspective as per para 15 that identification has to be appropriately done in the file and document for the judgment as well. In terms of ensuring complaint of related parties, there are various aspects like organization chart, which spoke about investment records, bank confirmation, and legal confirmation, declaration by the directors, also searching for tax returns and various MCA records as well to identify the source of information by where you will ensure completeness of related party transactions. Is okay. So moving on, once identification of related party has been done, the next critical part will be the process and the controls. So basically to do a DNI is a walkthrough and a test of effectiveness as per auditing standards, and this is also required from the IFC reporting. Since there are reporting in terms of IFC, so there also we need to be mindful about what type of controls are in place. In terms of entity level controls, would a mechanism in terms of approval mechanism. Many of these companies, listed company space, will have a whistleblower policy, ethics policy, identification of related parties, even the arm's length evaluation and review of RPTs. Many of these companies would also have their own IT where the data would get collected. What is the control over that aspect as well? So this is very critical process in terms of, since many of these companies which we audit would have an IFC, this is very critical in terms of what management has a control in process, and this is very at an entity level controls. So this is one other critical aspect, that there are procedures where previously undisclosed related party transaction has got identified. How would one record in the subsequent period? So here also you need to be mindful that the way. So here in terms of the question is on inspection of directors, this declaration of all directors of ABC, the engagement team noticed that a key managerial person, okay, holds 60% in PQR. That means it's having a control over the other company PQR. Company PQR are not disclosed related party in part of by management. So here again, you need to be very mindful in terms of getting the list of MVP, all inquiries management, evaluate all related party transaction. In case if this particular observation is there, that also with NAFRA and various regulatories have been pointing out that this particular thing are missing in terms of overall evaluation by the auditors. And also given that this got missed in the previous year, next year for subsequent period, the auditors would have an increased assessment of from the risk perspective. They will enhance their risk to say that there were new identified risk in terms of non-identification of related party. Also, there would be a concern about the control deficiency, because this particular thing management should have identified as part of their control mechanism. If they have missed to report this also will have to evaluate from the impact on the IFC reporting as well. And also from a CARO perspective, from a so-called a long form audit opinion perspective, there are sections 77, 177 and 188. If this needs to be complied, assuming this particular case was missed, so there will be also be reporting implication for these two clauses as well. These are on the as we move on, will be on a business purpose, the commercial sense, commercial substance, in terms of why there are related party transaction, and at many times the same have been missed by documentation by the management and by the auditors as well. So here, all these things, like there, we need to have a documentation is where it is an arm's length one, or it could be in normal course of business. If anything is outside normal course of business, you will need to evaluate this. Also from a transfer pricing, also you need to evaluate this and appropriately discuss with those which charge governance as well. So here is case study for where a company XYZ appointed company LMN as its agent to exclusively sell the company product. Director of company XYZ is also promoter of LMN. Also promoter company XYZ is not about any of this. So here will be very critical, and generally this happens in a promoter driven company where they may appoint some of their own sister concern as a part of a selling agent or part of their marketing collateral agent, but there are no transactions, but there are no relationship with them. So there as an auditor, you have to be really mindful into see whether how these particular transactions are there, why is this a business and commercial sense to have a transaction with those identified parties. Also here, this generally happens in terms of MNC. Say take an MNC is in UK and India is their wholly owned subsidiary, or it's a subsidiary in India. So the critical part is, see here, there is a monthly invoice by, in our example, by UK firm to UK company to an Indian company for management services and fees for this, for software which they provided. Generally, when you have an MNC, they'll give their setup to, like in terms of legal services, or to use the common IT platform and all those things, and then they would also request the Indian company to pay back some charges. So here the requirement from the auditors was that the requirement at year end, the auditors and the management have ensured there are always intercompany invoices and obtain intercompany confirmation. The expectation from this NAFRA is you will not stop only at vouching for the intercompany invoices and obtaining confirmation. You will have to see for the substance of the transaction. Was a really been service rendered by the UK team to the India company where we're auditing? If no, those will get a qualification because it's not in commercial sense or business rationale for it. Evaluate the arm's length. In terms of the arm's length, the definition is it is basically if any transaction with two related parties conducted if they were unrelated. So if they're unrelated and there's no conflict of interest, those price which do going to be charged, that should be an arm's length thing. Here in terms of in an audit file, we'll have to demonstrate that this particular thing, as one of the colleague inquired, what happens from a transaction where you'll not be able to substantiate an arm's length, then you'll have to inquire through management, and if even management is not able to substantiate it, it may turn up to we'll not be able to provide a clean opinion. Probably there would be need to justify, management has to justify, otherwise it will be turn up to a qualification or modification audit opinion. After all this process, the other critical part is in terms of communicating with those charged with governance. Those charged with governance are generally the board of directors. In this case, in fact, in our audit opinion, where generally when we give an audit opinion of 10 pages or 8 pages, then followed with CARO and IFC opinion, one of the para as part of auditor responsibilities, we communicate with those governance any significant risk or in terms of any sort of a materiality and all those things. So if we believe that related party is very critical to organization, so those are the governance, we also need to have a proper communication channel by explaining them in terms of any non-compliance, in terms of identifying parties, anything in terms of process there are any lapses in process followed, or those are related parties but not disclosed, those anyways has to get impacted. So those will be communicated to those studies. Governance is very critical as per para 27 of 550. And if and assuming here the things are as per auditing standard, so shouldn't be much of concern. If assuming they are not in flow of the auditing standard, those will be also be qualified and will discharge with those are governance. So there's an interlinkage of the related party as per SA 550 Ind AS AS with this CARO. So there are many clauses in CARO where one would have to report whether the investment made are and the loans given, whether this are without any periods. For an example, generally we see that Holdco giving a loan to a subsidiary and repayable on demand. There is no term. So here, as per CARO, auditors has to disclose the nature and demand in terms of any repayable on demand, the quantum of loan which has been there on a balance sheet which doesn't carry either no interest or there is repayable on demand. So this is on regarding to compliance with 185, 186 with loans, investment, securities and guarantees, which is with the various clauses, clause 4. And in terms of 177, 188, this would also, sorry, in terms with 177, 188, the compliance will also be required to be specifically commented upon by the auditors in their CARO section. So at end of this session here, there are various opinions which from these are in public domain, where CG Power, there has been a disclaimer of an opinion because they've been calling about for a connected parties, where they have given a disclaimer of opinion, where the auditors were not able to obtain a proper information, and this information was not been properly, even the controls were not been effective. From a Fortis as well as in Coffee Day, there has been a disclaimer of opinion where there was a proper transaction happened with the related party. Okay, but in terms of the evaluation, in terms of getting back the money or in terms of interest being charged and getting money back was not appropriate. So there was a disclaimer in this. Even in GVK, there was certain transaction where with the related party where there was a qualified opinion as well. So friends, here you just be mindful. As I told you earlier, it is not only a notes to accounts related auditing standard. You have to be mindful in terms of right from identification. Identification is very, very key. Once that is done, probably the second bucket in terms of transaction, the third is arm's length, the fourth is disclosure, that will fall through. The first is identification. Many of this, especially these two were on identification of related parties as well. So what needs to be, you need to be mindful. As I told you, completeness of related parties is super critical in terms of this auditing standard, where one needs to be mindful about in terms of related parties, identifying all related parties, connected parties as well. And we, as an auditor, definitely we are the management has to first come out with a business rationale and commercial sense, and then as an auditor we'll test them to demonstrate that we have reviewed those. Here we'll have to ensure all requirement of Companies Act requirement. If it is not in arm's length, you need a board resolution. And if it is above the criteria of section 188, those requires an ordinary resolution from shareholders. Assuming this is also from a SEBI perspective, also as I explained you, those needs to be very mindful about it. And as the last thing is, which NAFRA in all their audit observation has kept on mentioning that there should be an adequate disclosure. So adequate work to be done on arm's length testing, which is missing in many of the audit files, where it is first management prerogative, and as auditors, we are generally a gatekeeper. We will review those which the management has done and satisfy ourselves in terms of documentation. if for interest, I can just flip through the Word document of all these four top sort of qualifications which we had. So connected parties also, I could think about one of the example which when I was doing an audit. For an example, you are audit of doing of a company who was saying having a heavy cranes or equipment. The management, what management has done is they have always sources the particular crane from say globally from say Indonesia, and it's a second in crane. So they will appoint an agent out there and tell an agent you procure on my behalf. So here there will be everything will be very proper. There will be a quotations and everything. But basis the smell test, what happens is when this particular equipment when it comes to India, for an example, the transaction happened 100 crores. When that particular and they got three quotes, one at 105, 110 and 100. So with 100 crores, probably the management was okay to deal with. So the transaction got compensated and transaction was to reach to India. At India, there is always a customs who does the valuation. Per custom, it came to 110 crores, the valuation. Now here at the smell test, you'd be very mindful about it. Why if customs is say 110 and we got three quotes, 105, 110, why 100? So probably when you dip dive into it, all you know that this particular agent, again a connected party, has taken money of 100 crores from the company and probably has kickback given to promoter in his Swiss account as well. So here you have to be mindful. Nothing is right, nothing is wrong. Whatever you do, you have to be mindful about all the transactions, specifically with related parties and also unrelated connected parties as well. Because here in this example, when you do a smell test, you realize that customs are saying 110 crores, but the one which is there, the three quotation, one was 110, other was 105, and the third is 100. So this could happen that there will be two connected parties or whatever. So you have to be mindful about whenever you do related parties, be professional skepticism in terms of any transaction which management does outside India as well. Just don't blindly say that there's an agent who got appointed and he has done the three quotation and the lowest quotation we have obtained. So just be mindful there. So these are the few examples snippet which I had taken it from the annual reports. So here if you see, here they're talking about certain identified person. Certain identified personnel as well. And there also they're talking about something on connected, yeah, here. Connected parties. So this was for CG Power March 20, where there were disclaimer of opinion. Fortis also was a transaction with the related parties, where SEBI has sent them a notice and the erstwhile promoters had siphoned the money from this company. The third one was on Coffee Day, where they are where has not provided sufficient evidence in respect to recoverability of dues. This was for Coffee Day. And GVK has also had certain sort of a transaction where the directors, the promoter had some interest in the relationship where the transaction is commensurated. So these are the four examples. There are many right now in public domain. And if you see, this has now got more attention, probably post March 19 or March 20. So friends, here you have to be mindful about in terms of the transaction which happen with related parties. Yeah. Any questions on related parties?
Going
Is
that
there
side.
any requirement to publish the link of related party on the website, company website?
No, nothing. But in terms of if you're from a SEBI perspective, you will need to have a policy which define how to define a material transaction. That needs to be there. Nothing to publish unless in any of this unlisted or listed type of companies. So the next topic is on going concern. At times, again, this is one of the standards during my articles time also, we used to believe that should not be much of a concern in terms of what happens in terms of going. But after, if you see the COVID during March 20, March 21, there has been this particular standard, and also guidance has been brought by ASB and institute, and well as very international accounting and auditing framework also got to fraternity were also talking about this going concern. So going concern is one of the challenges which generally happens, and which as an auditor we don't pay utmost important. So going concern also, and also here many of this management, rather when you have a risk control matrix from an IFC reporting, they will have very proper for sales, purchase, acquisition of PPE, treasury. They will have a perfect risk control matrix document. But when it comes to an IFC, they believe the management believe it is auditor's prerogative to do it. But as an auditor, unless and until management gives us a complete set of a projection for 1 year, as an auditor, we can't step into their shoe of management. So one very critical, specifically, this is an eye opener post COVID-19. Someone would say that what type of evaluation would one need in terms of having a documentation in the file, and more so it's a management responsibility to ensure that all documents are appropriately there in their expectation. And second one is also at times what we have seen is this needs a 1 year evaluation, complete evaluation of going concern, but at times the board may not have approved this particular going concern or cash flow projection. So cash flow projection has to get approved by the board as well, in terms of they approving it as an auditor. As I keep on saying, we are a gatekeeper. We will take note of it and will accordingly consider those and perform some sensitivity out there as well.
It got stuck, yeah.
No. And other misconception in terms of going concern is what should be the period? If you ask anyone the period, someone would say 4 years, 5 years. The critical part is the period has to be, someone would say 1 year as well. There's a right way 1 year. But when would the 1 year start to stop? For example, when I'm doing audit of March 23, would this be taking a projection only till March 24? The answer is no. The answer, the way the going concern auditing standard has been drafted, it says up to a subsequent event date. So, i.e., when I'm signing an account on, say, 11th of September, technically you need a 1 year projection from October 1st till next September. And this part, like April to September, which 6 months has been passed, as an auditor, we'll have to obtain those to check whether those are in line with the budget. Assuming if they are in line in budget, at least that gives an assurance that what management is prepared as a robustness to accept it on the face value. Otherwise, it becomes a challenging process for us. So how do we expect that what management has given is appropriate or not? So here also there are a couple of qualification or say disclaimer of opinion in terms of going concern, which there are a couple of examples. I'll take it in the end of the session. So this is an overall index. Going concern, what is going concern? We'll take a quick snapshot. Going concern, one of the other consideration in my experience with gray hair or no hair is generally we take it very last. So I generally tell to my colleagues as well as friends like you is please consider this at the time of a planning stage. Planning stage could be 3 weeks, 4 weeks ahead of your sign off dates, or when you're doing a listed company, you can do it in month of December, January. So there are no surprises from management. For management to give you, though management has to satisfy an auditor, but generally they also complain that you are bought in a very last moment. Again, the same thumb rule which management generally forgets, that auditors are the gatekeepers. It is management who has to do a proper documentation, and as an auditor we will step in. So here, though at a planning stage, as an auditor, we need to ensure that this particular working has been received, not at very late at a later stage. Again comes here communication with those charged with governance. In many of the cases where either in NAFRA or non-NAFRA, many of this management believes that as an independent director, they don't come to know unless until someone tells them. As a management will never go and tell them. As an auditor, our duty is to say is in a smell test, if there are any of the criteria which are not meeting, what has management done to mitigate those? Those need to be communicated with those at governance. And there are auditors consideration, like once you are almost in the planning to or closing stage, as an example, you will have to see what type of communication, what type of criteria would this going concern will get bucketed. There are some 5 criteria which I just shown. There are case studies and a live example and report. So here going through a going concern, why it is necessary, why it is needed, is generally a question which comes to everyone's mind. So one of the thing going concern, as per the accounting standard framework, there is assessment by an entity to able to continue the going concern. So while we're talking about while talking going concern auditing standard, you need to be mindful that there's a framework under Ind AS to capture this one. Two is the in Companies Act, section 134(5) say that require the board of director of every to state it's the responsibility of director that their accounts are prepared in going concern. It's very, very critical from the perspective of the director responsibility. And assuming the going concern basis is accounting is used, that means when you believe that the company will not be able to continue in this, then you'll have to realize you have to account those in as per the liquidated accounts. These are the objective of SA 570. Definitely, again, the same, since it's an auditing standards requires auditors to obtain appropriate audit evidence for the particular in terms of going concern. The period of management assessment, as I mentioned earlier, is that you need to have from a date of approval of financial statement. And here, for an example, when I'm signing up September, you will need to technically get till next September 1 year and not April to March 24. This is as per para 9, para 13 of SA 570, auditing standard 570. From the auditor's consideration, again, I'm trying to overlap it with CARO 2020 requirement. Here, the CARO 2020 requirement says that the clause 19, which is on basis of financial ratios, aging and expected date of realization of financial assets and liabilities, other information accompanying the director's report, the auditor's knowledge of board director management plan, whether the auditor's opinion that no material uncertainty exists at date of auditor's opinion, that company is unable to meeting its liability. So here, though it's a subset of a going concern, but not directly related to going concern. The reason being is here they're only talking about the perspective of from of cash flow or from the fund perspective, whether there's any mismatch to that they'll not be able to pay on the on the balance sheet date and which falls due for 1 year. Here, from a going concern perspective, one needs to be bear in mind that it's not only this liability. You may have a liability, but assuming a particular company, the license got cancelled. As you're auditing on say on 8th of September, there is a classic example of say I'm a company where I import lot of servers or computers or laptops from say US. Now there is a import restriction applied by the government. Now, if you see the company's balance sheet, they are very healthy. Like if you see what cash flow, the current assets is healthier than current liabilities. They have a cash for next 1 more year. Now, the only concern would be that this criteria would meet. CARO, you will give to say that there are no observation. But if you read, if you to see the overall business, there will be a concern because the management would not be able to carry on a business because there is a import restriction implied by the government. So going concern, so those will be a proper going concern. From a CARO perspective, it is more about talking about your cash flow payment for the next 1 year. Also, assuming there is a going concern in terms of material uncertainty, which we're going to talk about, or there's a qualification, that got disclaimer of opinion. All those also generally auditors miss out to talk about. There is a separate clause in the 143F, which says the observation of comments and auditors on financial transaction or matters which may have adverse effect on functioning of companies. So generally, some auditors would definitely would give a proper qualification, but there is one more in our auditor's obligation or powers and duties. We have to also to respond on clause 143F, where there is which will impact on adverse effect on functioning of company. This also from also going concern are also been talked about having an effect. So this also need to be bear in mind whilst you're drafting any modification on account of going concern. In terms of the responsibility of the management, so here as per auditing standard 2 and as per Ind AS 1, as I told you, the accounting framework, the management takes the utmost responsibility to prepare the account as per going concern. And if they believe that it is not so, then the account will be prepared as per liquidated basis. But management takes the utmost responsibility. And here also, at least they should have a visionary of 12 months. In terms of auditors, the objective is to obtain appropriate audit evidence to conclude that management use of going concern basis is effective, and to conclude whether material uncertainty exists on which cast a doubt on the going concern. So if there are any material uncertainty exists, then as an auditor, you will have to evaluate. And there are, I'll just show you in a subsequent slide, there are 5 or 6 buckets, like when there are going concern issue, how each of the aspect would get covered, whether it is whether it's a material uncertainty, whether it's a disclaimer, it's an adverse opinion, or and so. And yes, those as governors would still continue to have a responsibility on overseeing the entire financial reporting. As per SA 705, para 34. So now these are the, as going concern, one is to identify at a very early stage. So at a planning stage, what needs to be considered? So here generally someone would bucket into 3 aspects. One is the financial indicators, could be an operating indicators, and if those not falling in this would be in others indicators as well. So not necessarily one of this would be one of this would lead to going concern, but yes, if management has a mitigating controls to it, then at least you can document and say that there are no going concern, really a concern on going concern. So here, for an example, there's a net liability. For example, net liabilities are more like net liabilities say 50, the liability is 50, the current asset is say 40. So it's 10 rupees in crores would be net liability. Now, how would does management has a proper plan to say next 1 year how they are going to perform to mitigate this risk? Breach of covenant. This is very, very, very critical in terms of breach of covenant for both aspects. One, if you are doing for the audit of March 2023, those also needs to be taken when you're doing audit for March 2023, assuming there is a default of payment of interest and also the default of any ratios. So then this being and as per the bank arrangement, if for any default of ratios and payment delay, they have rights to recall the money. So assuming the bank has right to recall the money, then they can, if they want to call, and so all these loans which are there in the company are presently parked under long-term liability. So moment you call it a classify as a short-term and it's supposed to make the payment, then would there be a going concern? The answer would be yes as well. 1. 2 is breach of covenant. Also look from a going concern evaluation also. Once you're taking as an example, we took from September to next October, or rather October to next September. There also, if there are companies has a certain condition for to meet with the bank loans, those needs to be also be mindful. Assuming as per the own management assumption they are not able to meet, so then it will be classified as a short term and would probably would also need to evaluate from a going concern. So again, this would be falling in this bucket then. And inability to pay creditors on time would one of the other indicators where one would be watchful for. Then here would be from an operational point of view. Okay, critical is that KMP, the CEO or a CFO or any other C-suite have left the organization, but there is no replacement. So this could be one of the indicators that you need to be mindful about it. Shortages of supply for whatever reason, it could be between UK and between Russia and Ukraine war, where there is short for supply of chips. So how does it impact India when someone is doing audit of probably that particular sector? And here, management intention to liquidate or cease operation also could be in an example like there could be a legal case which is ongoing, and the legal case is on premises that the license were wrongly given to this entity. So those also you have to be very, very mindful in terms of what would happen. Like the matter may be pending with Supreme Court for decision, but that also needs to be mindful about it. How does management take into consideration of this as well? And yes, definitely non-compliant with statute pending litigation, which I just explained. This could be also you need to bear in mind as a part of a going concern evaluation. Now, so this assuming we have identified this particular thing, and there are cases, for example, breach of covenant, blah blah blah. So one of the critical thing is we'll have to obtain a forecast, board approved forecast. One, if not approved, we will have to insist as a part of board to get approved. Generally, management would also push the auditors to say that why don't you take it part of a representation letter. Here, we are very mindful that or the board has to approve this. Now, there are cases where board later on argued with the management or the auditors that we have never approved this plan. So what auditors have considered not to their knowledge. So and the purpose of putting month and quarter wise is like, for example, if you take April to September, which is the scope, if you have quarterly or monthly, what is the turnover, what's the EBITDA, that whatever management has projected, at least you can benchmark with actual performance of April 23, April, May, June, July, and probably till August. You can benchmark and see how is the robustness, because it's very, very critical in terms of how the management are working upon it. And reliability of underlying data. Say, for example, management will say that next year there will be 10% increase in the sales or 50% increase in the sale. What rationale do they have? What planning do they have? What analyst report can we look into analyst report? Can we look into sectors? Can we also see they may got orders as well, or how much is pending orders in the hand? So all those would be able to get a reliability of data, and definitely comparing an actual post balance sheet in my example, April to September. Assumption use, retrospective review. So here is very critical, which is this is one of the pointers which also Nafra has highlighted. There is no retrospective review. Retrospective review means, for example, March 23 got concluded. March 23, what was budgeted, what was actual. It could be critical parameters like revenue, EBITDA, various ratios, or cash. Same thing, at least the retrospective review, the expectation there for at least 3 years. So March 23 file you will have for March 23. March 22, March 21. So that if there is retrospective review, assuming it matches with whatever budget they have estimated, that gives you confidence that whatever future budget they are doing, that would be in line with their expectation. This is okay. Considering here also is very critical that probably in month of August they may, like in this example of I told about servers or a laptop. Assuming I'm signing in month of September and August end, there was a notification by ministry or to say that this particular license will get probably will get cancelled or revoked. So those considerations also need to be mindful when you are doing a going concern evaluation. And analyzes the entities key, like many of the listed companies or the private limited companies would have MIS. So whatever happened from April to September, this is to be reviewed and reading on the various minutes as well. And this is very, very important where many of us try to miss out is that in the overall consideration, someone would say that they have an undrawn facility. So if there's a shortfall of cash, they will have an undrawn facility which they'll be able to utilize it. Now, as an auditor, we need to be mindful that all terms are existent. It should not happen that undrawn facility says that the facility is available only till 31st of August 2023. We are looking for a period till 24th of September. Now, this cannot be taken into consideration. One. So all these things you have to be very mindful in terms of whenever you're doing any cash flow, when a management has cash flow projection, whatever consideration they have taken, you have to evaluate the underlying data records on this, specifically for a loan or a undrawn facility with management considered. Communication with those are the governance. Yeah, this is. As I told you, as a part of auditor's consideration, as a part of auditor's conclusion, once we did a step of getting the cash flow and looking into various aspects, now there could be 5 buckets in terms of auditing standard, with there are 5 scenarios where one of this would fall to. The first scenario is where there are no events or to say that there is significant doubt considered by the auditors. So this is very neat, clean company. They have a huge cash flow, all those things. So there is no event. So generally, bucket scenario 1 would be many of the company would fall out here with a very cash-rich company. Now take a scenario 2 where events or condition identified may cast doubt, but based upon auditor's evidence, auditor conclude no uncertainties. For example, in this company of UK or rather say I'm a subsidiary of a holdco which is there in UK or internationally. Whilst I believe there are various parameters of the identification on financial like net liabilities are there, but there are support letter being received from the holdco. So there, as an auditor, here you have a significant doubt, but basis audit evidence obtained, there no material uncertainty exists. So this is scenario 2. Scenario 3 is where event condition identified, material uncertainty exists. For example, a legal case is pending, and as a management, we have applied to Supreme Court. The matter is sub judice and not yet decided. So here could be situation where events have identified and material uncertainty exists. We don't know whether Supreme Court will give favorable order to revoke the license or would would allow the management to continue. So since this situation would be a material uncertainty condition, and when auditor considers there are multiple uncertainties. This is very rare, which the standard also has envisaged. But this can be a situation where multiple uncertainties as part as scenario 4, and scenario 5 is that management themselves assumes and believes that this account will the going concern is inappropriate and they will do a liquidation type of an accounting. So there are 5 scenarios. So in terms of what do you mean by material uncertainty? Material uncertainty has been talking for a long from this standard. The way it's defined is significant doubt on ability or intention to continue operation for foreseeable future. And foreseeable future technically is 12 months from the date of signing the account. And magnitude of such event condition or likelihood are such that appropriate disclosure are made to achieve this. So this is called a material uncertainty. And a close call situation is where when auditor concludes that no material uncertainty exists, yet additional disclosure are necessary. Like for example of the MNC company UK who's going to give a support letter. So here as an auditor, we would say that yes, basis the review of the various financial parameters, there are concerns, but it was mitigated by a support letter by the UK organization. So there in your financial statement, you will disclose this, probably this will call it a close call. These are in respective auditing standards in para 2021. So quickly, the various 5 scenarios. Scenario 1, there are no events. It's very neat, clean company, going concern, no doubt at all. Cash flow is high and all those things. So scenario 2, where the events are identified and cast out on this, but auditor. So here again, think about the support letter example. So here going concern is appropriate and no material uncertainty, but possibly a close call. Because since you have a support letter basis that as an auditor you have concluded it. So here you will have to disclose into financial statement. Management will have to disclose the factors in financial statement. And as an auditor, if the facts are appropriate, nothing to mention audit opinion. Assuming that the management doesn't want to call it, then there will be it will not fall in scenario 2, it may fall in scenario 3. So here scenario 3, where material uncertainty exists, an example of a legal matter where the matter is sub judice into Supreme Court, where it depends upon whether a company can take it forward on a particular, say, a telecom licenses. So here auditor should determine that adequate disclosure are dealt with them. Disclose clearly the material uncertainty that cast doubt. So this also has to be mentioned into the financial statement. Okay. Assuming management had disclosed this, so there will be a separate para called material uncertainty data going concern called MUGC in its short form, which will almost be like an emphasis of matter para, where the auditors will bring out this in audit opinion called material uncertainty, will draw attention to the account, to these notes where management is prepared, and would highlight there are factors basis of this. In this example, probably think that there is a legal matter, but however, the lawyers of the management are confident based upon the past trend on that this particular matter will be favorable to the company. So those type of it will be there. Assuming that management doesn't want to give any sort of a disclosure in financial statement, no disclosure are made, then it will be express a qualified or adverse opinion. So if management has given disclosure, then as an auditor, we will call it as a matter of material uncertainty related to going concern. If there is nothing, it may go through opinion of qualified and adverse opinion. As per para 19, 22 and 23 of FA 570. Here also we have to be very, very mindful. Sometimes, generally, this particular para, material uncertainty, is not a substitute for obtaining. If you're unable to obtain, we disclaim our opinion. For example, management has not got any, say, a legal opinion to it, and we are not aware about what could happen in future. So then, this is not a substitute to place it under material uncertainty and be close and sign the financial and close the account. It says that this is not a substitute. You need to have a, if they are unable to obtain opinion, you will still qualify or get an adverse opinion. The scenario 4, it is envisaged to be very rare situation, but the way it is read, there are multiple uncertainties. Okay, here definitely it will tend to be a disclaimer of opinion because there are multiple uncertainties and auditors are not able to conclude or not able to get a proper evidence. So technically this becomes a disclaimer opinion. It's a very rare situation, but in an example, in my the live example, there are cases where there have a disclaimer of opinion been issued by an audit firm. Here this is a case where management themselves, scenario 5, believes that the going concern is inappropriate. They will account it as per the liquidation accounting, where they will call all assets and liability into short-term liability, asset liability. So there are 4 case studies. I'll quickly run past through it. So here is a company X, which business of manufacturing cars and two-wheelers. Historically, company incurred losses till 20. However, company a positive EBITDA from 21-22 onwards, and we are auditing for March 2023. So history says they have losses, but this is the first year in the past history we could see that 2021 was a profit. Also, the revenues are increasing trend for 2021. Management has current liability position but positive net worth. Okay. The company has a borrowing with a scheduled repayment in next year. Company has other unutilized credit at a year end, which are backed by financial guarantee by parent companies renewed till 31st August 2024. Probably we will be signing in. Probably looks like we're signing on August or July 2023. So we have till 1 year. We have a proper signed unutilized credit facilities. Historically, the company will be able to renew credit facilities. Cash flow projection do not show any breach of covenants, which I just discussed earlier. Actual sales are in line, which I say that which we also seen. So here if you see all this fact pattern seems that it is scenario 1, no concerns at all. Whilst you have to be very mindful about it. In 2021 there was a loss, but 2022 2023 they have been able to come out of it. This is the second scenario where company is incorporated 2012, engaged in business of manufacturing and selling FMCG. Here also we are in March 2023. The company has losses and including current year as well. Accumulated net worth, it has positive net worth. Company has current position excluding borrowings repayable on demand from ultimate pairing. So if I want to consider this loan into this current asset, current liability, it may get negative. If I exclude it, it's a positive balance. And the company has received unconditional support letter to provide support for 12 months from the blah blah blah. So here after all the fact pattern, it will be scenario 2, which says that management, the auditor has obtained evidences and concludes that there are no material uncertainty because we got a support letter. And friends, here also support letter, whilst it's there in this SA 570, there is a format of support letter. But internationally, what has happened is the support letter, not a binding support letter. It's a piece of a paper given to the board of directors and blah blah blah. But tomorrow legally, if someone wants to see, there's no binding. So internationally, they are trying to get to one sort of an agreement or an arrangement, while like a corporate guarantee. When you say corporate guarantee, someone can encash because it's a binding contract within 3, and legally it can be tenable as well. So here right now, whilst SA 570 talks about one piece of a paper where say unconditional will support you by signed by the holding company, but friends, you have to bear in mind that like as we are evolving it, this may get changed and would need a binding contract like a corporate guarantee, sort of a tripartite agreements. So this is the third scenario where company A is engaged in business of chemicals. Company has incurred losses historically and also in FY22. So here we are in March 2022. There's case study 4, which is from March 23. So here right now we are in March 22. Company incurred losses and FY21 and 22. Company has negative operating cash losses as well. Net worth has current liability position. While company projection shows a negative cash flow, it expects the growth in 12 months while company final stage for obtaining this. So here the management is in obtaining. So they don't have any substantive signed binding term sheet. So here they're assuming that. So here the way one key takeaway is company is negative cash flow. It additional burdens. Okay, here very critical. It's a draft term sheet and not yet finalized as per expectation. So as per SA 50, we will say because there's a material uncertainty and cast doubt and unable to realize. So here this will be part of our scenario 3, where we'll call it as a material uncertainty MUGC, where we're going to call it as an emphasis of matter para for this particular case. Now case 4, now the same company, we are in March 2023. The earlier they promised that they would have a growth in next 12 months. Okay, so now we are in March 23 for same company. So here company is continued negative operating. Company plant has stopped functioning from December 2022, and company breaches of default in this. Company are not able to pay statutory dues, and also there's no binding signed contract. Earlier in March 22, the same management said they're going to get a signed deed, but right now till March 23, when in next year, still there's nothing binding. So here we given there are multiple instances of potential breaches, the plant which has stopped functioning operationally. So here it may tend to give a disclaimer of opinion to be issued. Okay, earlier when I told this may rare situation, but one of the case I'll just show you in the case in this final fact, there is one company where there was a disclaimer of opinion being issued. So friends, here you need to be very mindful in terms of 5 scenarios, and which of the scenarios audit the client, which we audit or be part of management, which are the scenario they fall into. So these are the 3 or 4 examples where in TRF there is a material uncertainty related to going concern. So what they are saying is, we draw attention to note 40. This is note which they say the compare an erosion of its and preparation financial statement is going concern based upon assumptions opposite note. The company ability to continue going is generally expected cash flow to meet obligation and arise when uncertainty. So here if you read the notes to account of the management, this is what auditors have classified under material uncertainty relating going concern. Here they think incurred losses of X amount and accumulated losses of Y, and has eroded a net worth of the company. The company expects to generate improvement, increase business, increase efficiency from so and so, proceed of this, renewal of facilities and SFL, which will sufficient to will be able to generate a future cash flow. So because this, the auditors have given a material uncertainty related to going concern. The second case is on Reliance Power, where there are certain injuries where note number 20, note number 24, standalone. The fact are more disclosed in aforesaid note relating to losses incurred during the year, excess of current liability, current asset aggregating so and so that have fallen due and has been reclassified as current liability by respective statutory auditors. For which the company is a sponsor. So here what happened is, still we're in standalone. Whilst we are reviewing the subsidiary, the Holdco has given, and the auditor of Holdco, the Holdco has given a guarantee to subsidiary and the bank. Now, there's a default by subsidiary. So since you are a guarantor, you will have to make good the losses. So, and if this particular thing gets to in a standalone account, the standalone has an obligation to pay to the respective banks of the subsidiary. That is why this particular para has been called into MUGC, and this is what the management has put on a note to the accounts as well. And here is a disclaimer of an opinion where in view of matters 1 to 6, that there are others matters as well in this company. Also, this company had related party issues. This company had cut-off related matters. This company has impairment issue. So they say that in view of matters expressed 1 to 6 and in absence of reliable cash flow projection, if there is no reliable cash flow, an auditor will not able to substantiate, we will say the disclaimer of opinion. So they have the disclaimer of opinion. And any consequential impact of those matters alone, we are unable to comment on appropriate or going assumption adopted. So, and here also, in my 143F, when I said earlier, so this in the adverse remarks relating to maintenance and other matters connected there will are stated in basis blah 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 in para 1 above. So this also as an auditor, when you have a disclaimer of an opinion and it's an adverse functioning on the overall of the company, as per 143F, you will have to also talk about this. This is what auditors has been mentioned in their in audit opinion. This is the last slide in terms of assessment. The responsibility would be on the management. As an auditor, you will never be able to predict future. But yes, we'll not be able to predict future. But based upon our analysis, based upon the company knowledge, based upon the budget, based upon the framework of this, we auditors are satisfied with whatever information we have got? If answer is yes, though we cannot predict future, but whatever it is, we have to justify and document into audit files as well, which is one of the other NAFRA observation that auditors doesn't have not documented things into file to say why going concern is appropriate. And as an auditor also, whilst we get this particular evaluation of the going concern in terms of cash projection, as an auditor, we have to apply sensitivity. For an example, if the management has taken 10% sales growth, as an auditor, we say let's do 5%. Why 10%? My management has said that debtors would pay in 1 month. We said debtors why 1 month, why not 3 months? So those sensitivity also needs to be performed and kept in the file. So once you keep this, and in spite of the sensitivity, still there is a closing cash position. As an auditor and as per auditing standard, as an auditor, you've done work appropriately. And not disclosing going concern may result in liabilities on the directors, especially independent directors. Particularly, company goes down at least within 12 months or thereafter soon. And therefore, assessing going concern at an early stage of preparation is important, because that would also allow management to prepare and have a conversation with those governance or also with the lenders to get to see any undrawn facility they could get through. That's it. I have any questions on this thing?
Okay.
And this was a little heavy topic in
Yeah.
terms of related parties, and that is why I inquired who are if there are auditors in this room, probably they would comprehend more. But anyways, thanks for the session.
Thank you. Thank you so much. Thank you, Suhasji, for this. Thank you, Suhasji, for this very in-depth, knowledgeable session on the standards of auditing. On behalf of the JB Nagar Study Circle, I would like to propose a hearty vote of thanks to CA Suhas Pai for sparing his time and sharing his immense knowledge and practical experience on the two important standards of auditing, SF 550 related party and SS 570, that is going concern. He has explained the nitty-gritties of both the accounting standards in detail with relevant case studies. I would also like to take this opportunity to thank the coordinators for today who have helped us in arrangement of the today's seminar. I would like to quote American author Brian Herbert. He says, the capacity to learn is a gift, the ability to learn is a skill, and the willingness to learn is a choice. So congratulations to all who have chosen to learn today. And thank you again for coming in attending. Thank you.